Let's touch base with the macros of the economy as promised, given that there have been quite a few data points over there. Who better than Sajid Chinoy, India economist at JPMorgan, to discuss the same. Sajid, to start off with, it's the movement that we're seeing in the bond yields, which seems to be surprising everyone, rising to the highest level in 3 months. What, in your opinion, is likely to be the trajectory for the bond yields going forward?
Yeah, I mean, we have to recognize that, part of the reason that bond yields were depressed in the last 3 months was there was no real supply. There were no weekly auctions for the most part for much of that period. And there was the expectation that there'd be, a lot of rate cuts from the RBI. Both those phenomena have reversed now. You've seen that once the supply comes online, yields will come under pressure. And there's been a clear signal from the central bank that the space for more easing is quite limited. For me, however, I think the main variable that will affect bond yields in the coming year will be credit growth. If credit demand actually picks up, it's very weak at the moment, given that banks are holding far more government bonds than they're expected to under SLR requirement, then yields could come under pretty significant pressure.
So you don't think that this could be here to stay? There could be multiple trigger points which would actually put the yields under pressure going ahead over the next couple of months?
There will be. I think, the supply calendar is quite strong in the next few months. At the same time, you'll have a lot of open market operations, I believe, by the Reserve Bank of India, which will at some level cap where yields are. Remember, the RBI has to create base money in this economy if nominal GDP growth picks up next year, for example. And the only avenue that the central bank currently has to alleviate interbank liquidity conditions is by buying government bonds. There will be very little opportunity for it to create base money by intervening in the foreign exchange market, given where the BOP dynamics are.
Sajid, safe to say that the macros aren't looking stable at all. You have the trends in the quarterly GDP at close to 4%, CPI in double digits, added to this all of the political rumblings, and I think the latest blow would be the current account deficit numbers. What do you make of this, and what do you believe is the biggest concern and that the government needs to do to address the same?
You're exactly right. The focus in so many quarters is on boosting growth. I think that has to be a secondary priority. The first priority has to be to restore macroeconomic stability. Now, to be fair to the government, they've begun that path. One key vulnerability was the large fiscal deficit, and we've begun to see over time that the fiscal deficit is coming under some modicum of control. The elevated current account deficit is a very significant challenge. I think we won't have numbers like we had last week. It's unlikely the deficit's going to touch 6.7% of GDP anytime in the near future. The overall number for this year is more like 5%. Next year it may come down to about 4.5%. But that still means we need to attract anywhere between 80 and 90 billion dollars of foreign capital every year. And what's worrying for me is that the fraction of foreign direct investment to finance the current account has fallen quite sharply. So we've become much more reliant on portfolio flows, other kinds of hot money. And so if, for whatever reason, the global economy goes into risk aversion, we will really struggle to attract that capital, and the rupee could come under very significant pressure. So I think that has to be the primary focus, is to keep inflation low, try and contain the current account deficit, and restore a level of macroeconomic stability before we think about jump-starting growth again.
What could change this, Sajid? I mean, because I'm guessing a large part of the reason why foreign money is not coming in is probably not just because of how the economic situation is, but also probably because how the political situation might be right now. What could change things for money, and not hot money, but FDI money coming meaningfully into India?
Yeah. I mean, to be fair, we've been lucky. We've been able to finance almost all of our current account deficit this year without much depletion of reserves. Reserves have only gone down by about 3 billion or so. But you're exactly right. The composition of financing needs to change. For me, the biggest constraint really is bottlenecks on the ground. The ease of doing business in India has gone down very sharply. So whether it's land acquisition, coal availability, raw materials, environmental clearances, other policy clearances, that for me is the biggest constraint on domestic investment. And FDI is always a complement to domestic investment. So when the investment cycle picks up, then we'll see more FDI. So for me, it's not so much about interest rates or about other reforms that will boost sentiment. It's about doing the hard work on the ground to ease some of these supply constraints.
Sajid, you do